So, I'm now the one thing standing literally between you and your lunch. So I feel the pressure. I'll be short. For those who have been attending these before, I kind of like to talk about market developments, scenarios, energy scenarios, and so. I won't be doing a lot of that today. I thought, given the events of this morning, we should just change the presentation a little bit and more focus around this, right? What is society telling us? And what is society telling us as the oil and gas industry? So what I'll try and talk about is what we see happening within the industry and what are, we believe, the two big dilemmas that the industry is facing right now. For those who want more background reading, I won't go through a lot of technical details. There are some articles spread out around your tables. We'll also make it available online with all the details behind what I'm about to say. So it's society versus the industry. And how is the industry responding, I guess, is a bit the question. And I promise very little on market outlooks. But it is important to understand the context that we're in. Right? We're moving away from a world that's growing quickly in energy, where only a very small part is actually renewable energy, to a world that is increasingly growing less fast in terms of energy demand, and it's going to be much more renewables. This is not wishful thinking, this is actually already happening, as we know. And this is happening for a couple of reasons, and the most important of them is just economics, right? Electric vehicles becoming cheaper over time, but also solar and wind becoming lower cost versus other sources of power generation. So, at the same time, stakeholders are kind of putting pressure. As we saw this morning, as we see in the newspaper almost every day, as we saw in the UN Climate Week a few weeks ago in New York. But it's not only about the outside world, it's legislation. It is actual shareholders giving messages. And if you just look at the share prices of our industry, and if you look at the oil and gas index, if you sort of start with a year where oil prices were not very high and just track it from that moment on, you see that the oil and gas industry is actually starting to lose compared to whatever index you put on it. And people like the Petroleum Interest Weekly from our host here are starting to suggest that, hey, maybe this is a signal that our shareholders are starting to give us, that they don't see what the industry is doing on kind of how to respond to the challenge. So with all that, we believe there's two questions that the industry should sort of ask itself. First is around what is the cost of the carbon it emits itself? What can they do and what does it cost? And the second is around, so what are the portfolio choices that they need to make? Think about the carbon cost. I'll in a minute talk about the 5 gigatons or so that the industry emits, 4 to 5. If you start to put a number to it, let's say just $10 per ton, that would still be a 50 billion tax to the industry per year if we would have carbon taxation all over the world. Let alone if that number gets to 50 or 100, like in some countries is already starting to happen. So this is big numbers that the industry should start to think about. And of course the other one is, I'm sure that is happening in all of your boardrooms every day, how to think about portfolio. Stay fully in oil and gas or shift and how to think about it. I don't pretend I can answer those two questions today, but at least I can help frame them and give you some food for thought. So first of all, if you look at the carbon emissions, if you look at what the industry emits before it effectively sells a barrel of oil or a cubic meter of gas that is actually used, in the narrow definition it's about 3.7 gigatons. In the more expansive definition, which really includes all the hydrogen that gets in, the trucking that you need to do to get the fuel to a retail station, then you get to more than 5 gigatons. That's more than, for example, the cement and steel industry combined. And this is before burning the product. Because on the left-hand side, you basically see that of the total energy-related emissions, around half comes from oil and gas. So it's quite something. But also this famous scope 1 and 2, that is sort of before you burn anything, is not a negligible amount, to be clear. And if you would follow some kind of a Paris logic and 1.5 or 2 degrees logic, then you get to formidable amounts of lower carbon emissions that you would need to get to. 50, 60, 70% over the coming years. And at the same time, if you are in society and look at some of the indicators that are well tracked, like gas flaring, not that much has happened over the last few years. And in actual fact, over the last year, it has gone up, right? Thanks to the Permian. And this is a simplified version, but with some colleagues and with people from the industry, we started to think about, so what can you do? And what are the parts of emissions that the oil and gas industry could actually move on? And this chart you see on the x-axis, the horizontal axis, you see the cost per ton of CO2 avoided. And in the y-axis you see scope 1, 2, 3, and we just dubbed it X, everything that's not scope 3. And what you see there is that the industry actually has an opportunity in the bottom left to start to decarbonize its own operations. Think here about electrification of existing, let's say, diesel equipment, rotating equipment. Thinking about using renewable power for its own power usage. But also thinking about measures to reduce flaring, reduce methane emissions. And those actually add up to quite some big numbers. Quite some big numbers. And of course, more to the right-hand side, you get the more adventurous stuff, more right up, like synthetic fuels, more at scale carbon sequestration and so on. But I guess the message from this chart hopefully is also a positive one. A lot can be done within what we would in Europe consider reasonable CO2 cost. Now we've developed a framework which I won't go in too much detail, which is what ultimately each upstream and downstream company can think about what are the ways to reduce and decarbonize. It's becoming more efficient in your energy, seeing where you can remove emissions, for example, through reducing flaring, but actually it is also around replacing feedstock, replacing fuels you use in refining. I think also here about using green hydrogen as an input into the refining process, like some companies are already doing. And as a positive example, when we looked with one operator in a lot of detail, we actually found that they, through a combination of measures, could actually reduce their emissions in a way that was NPV positive regardless CO2 prices for about 30–40%. And then the next chunk was at CO2 prices below $40. And yes, there was a remaining part that was pretty expensive to decarbonize. But so I think out there, and we've done a couple of these exercises with sort of firms like yourselves, there is good news out there as well. It is doable, the technologies are known, but of course it is not easy to kind of execute all of those. And then the other question is, what can the industry do together? For example, the issue around methane has been mentioned many times. And as one example, we think the industry can work together here around really developing monitoring systems, measurement systems, and making those transparent. Of the 5 gigatons or so of emissions, two come from methane leakage, methane emissions. And they're frankly pretty poorly understood. And I think everyone would agree that those 2 gigatons are a best guess, an estimate. And the world would be probably better off if we could really understand it better. And then moreover, the industry could do things such as working together on R&D and actually unlocking completely new supply chains. Who's going to run the new hydrogen supply chain? Who's going to run the possible ammonia supply chain if we go that route for shipping, for example? So there's positive news in the sense that companies can do things, the industry can do things. So that's your carbon cost risk. Then what are the demand risks in the portfolio? And I'll finish up with this part, which is basically saying that as oil and gas companies are wondering, so where will I invest? Obviously, the eyes wander to the power sector, our neighboring industry. But the returns aren't that interesting, as probably no surprise. And this is a difficult chart to kind of get your head around, to say, okay, how do I move from double-digit investment returns to single-digit and at best sometimes even very low single-digit if I go after the auctions? So how do I do that? Well, companies are doing it massively, right? Many players, and we've just listed here a few, have moved into electric power over the last few years, have moved into adjacencies like mobility and even further out adventures. The map, the chessboard that I'm drawing here is sort of pretty colorful. So that makes for a lot of press clippings. But if you start to look at the numbers, so what are the numbers really about? So it's about 1% of the total asset value right now. All of these investments, 1%. Another way of looking at it is sort of on an annual basis, the world spends around 300 billion on renewable energy. Building new solar and wind farms especially, that's 90% of that number. And the oil and gas industry contributes about 1% to that pool. And it's about 1.5% of their total investment pool. So it's still very early days. When we think about the portfolio shifts, the industry is still very much, I would argue, at a crossroads. Where are we on decarbonizing our own assets? And where are we on moving our own investments in a different way? Now, I'm not here arguing that everyone should now tomorrow move into power. That's not my argument. It's just sharing the facts around, hey, not a lot has happened yet. And then there's, of course, the beautiful example of one company that has actually moved out of oil and gas into wind. Dong, as we now call it, Ørsted, is actually making pretty nice returns after their move. Now, arguably, they were a very fast and early mover, but maybe this is an example of a way that you could actually do it, but you need to kind of move ahead of the curve into the right positions. And then this is the other chart I was going to show, market scenarios. This is for the maybe not so happy news. If you look at the reference case scenario, and I've argued here, this place, that the world does need oil and gas for a long time to come. We believe that in our research centers, and our reference case at the top, business as usual, whatever you want to call it, is suggesting some growth still in oil, right? The world has enormous transport fleets. But at the same time, if you believe in electric vehicle penetrations that are a bit higher, more radical legislation around plastics recycling, for example, then it's not that difficult to actually construct a scenario that we call our accelerated scenario that would bring that number down considerably. And by 2030, it's around 90 something. But by 2035, it's starting to really drop into sort of some pretty dangerous territory. And you can imagine that if you plot the value of portfolios against these kind of numbers, you move from an oil price of around 70 to around 40, because then the whole cost curve changes pretty drastically. And then that would sort of wipe away roughly half the value of a selection of top companies. If you take sort of the big 8 oil and gas companies that are public, that sort of would take around half of the value away in that kind of world. So here's the dilemma, right? Trust on the base case scenario with a nice growth, or invest now or move now against a accelerated scenario, and not getting it right would be pretty expensive from a portfolio risk value. So with that very happy message, I wanted to end my little note. No, on a serious note, the optimism here is actually, I think, on the own carbon emissions. When we did the research again, we were quite struck by how big the number is, but also optimistic about how much the industry can actually do about it. And on portfolio choices, that is obviously the big question that I'm sure you're dealing with, but we're starting to at least help you all to put some numbers against it. So I hope that this was somewhat helpful and didn't destroy your appetite for a nice lunch. Thank you.
Thank you very much, Occo, for a fascinating presentation. I must say that today I've heard the word decarbonization more than in any other year than the past 40 years of this conference. So the extinction movement should be happy because we're moving in the right direction, right? Occo has time for a few questions. So who has the first question? Yes. Could you please have the background noise
yes.
less?
My name is Ziad Laban. I'm from Saudi Arabia. My question is, I was very surprised that you're linking the oil and gas going to power when one of your slides showed that actually the chemical and petrochemical industry produces less carbon emissions and produces much higher returns than utilities. So the way to go for oil and gas is not power generation, but petrochemical. And the growth in petrochemical is multiples of GDP. So I wish you a great lunch. There is a way out.
I don't think I can disagree too much with that. But this is free strategy advice you got here. Yeah. There's another question there.
Except, of course, that they're trying to ban plastics. Yes.
So, hi, Occo. Herman. Michelle Foss, Rice University. Occo, can you just clarify quickly? I've seen other results similar to the ones y'all are coming up with in terms of returns. I'm assuming that, like other groups, you all are including government support in those returns. So those are returns with government support for renewables, correct?
They are returns net to the equity owner. And in some cases, that is with government support. And in some countries it's without, but it's whatever is left over for the investor. No.
Thank you. It's Neil Morton at BP. Just following on from that question about the relative returns between upstream oil and gas and low carbon investments. One issue with upstream oil and gas is that historically returns have never been quite as high as had been expected, a day late and a dollar short, as somebody once said. They are more volatile and they are riskier. So when investors look at risk-adjusted returns, perhaps you'd care to comment on the relativity of those two sectors, please.
Absolutely. And this is a very important question, of course, because on average, and again, this is averages, you see the cost of capital for the oil and gas industry is around 7%. And in power world, it's more 5.5. So there's 1.5% difference. So the hurdle rate is clearly different. So that's absolutely right. And you really need to go into individual projects to understand how, so what is it, what I'm investing against. Because you see now more and more, of course, renewable projects getting enormous leverage, long-term contracts with a very different type of return profile and risk profile than your upstream oil and gas. So that's absolutely right. This is not risk adjusted. These are just the kind of naked returns, if you like.
Is there one more question?
Okay.
What?
No microphone, but I'll try to speak loudly. Sorry, Ted Polis with OMB. Why would investors, what you can understand, prefer to see oil and gas companies? I'll start again very quickly. Why do you believe investors would like to see oil and gas companies transform into something else that's low carbon rather than invest in companies that are already in that space? As you indicated in one of your slides, only 1% of the investment in the renewable space is done by the top 24 oil and gas companies. So is there a rationale? And if so, what have you heard?
Yeah, so I don't feel qualified, let's say just more a qualifier, on having a view on what investors want, but I can share my sentiment. So first of all, clarity is important. So I'm not suggesting at all that investors want you all to just move out of oil and gas. I'm not suggesting that. And I think it's actually very clear that there is sort of an oil and gas story here. What I do observe, though, is that oil and gas companies talk a lot about power. There's a lot of moves into all kinds of new businesses. At the end of the day, it's only 1% of the asset value. So then what is then the message? And at the same time, you observe that the relative valuations of oil and gas seem to be declining. Now, one can only speculate what's behind that. Is there some kind of risk premium in there, or is it just another reason? But I think that clarity might actually be an important one, rather than the actual choice. Make sense?
Thank you.
I think we're getting signals that...
Yeah, well, thank you very much, Occo. very interesting presentation and for answering the questions. So now we can